Hey, this is Jussi. I run a small investment firm that specializes in REIT investing, and in today's video I'm gonna explain to you why I think that REITs are indestructible. And I know that this title will ruffle some feathers, but give me a chance to explain to you why I truly think that REITs are some of the safest businesses in which you can invest today. And this isn't just my opinion, it's well reflected in the fact that REIT bankruptcies have been extremely rare over the past few decades. We've only had a handful of them, and most of them were REITs that owned lower quality malls and were over-leveraged. If you remove those REITs that own lower quality malls, then REIT bankruptcies are a true rarity. And in fact, we've never had a REIT that owned decent assets and was reasonably leveraged ever go bankrupt, which essentially proves my point that REITs are indestructible. And this makes perfect sense when you think of it. Here are 5 reasons why. The first reason why REITs are so resilient is that most of them own high quality essential infrastructure. Yes, there are some REITs that own more cyclical properties like offices and hotels, and some of you probably wouldn't count these as essential infrastructure, but you should know that these are a minority. They only represent about 5% of the REIT sector. Today, most REITs invest in much more resilient property sectors like apartment communities, farmlands, cell towers, data centers, manufactured housing, single-family homes, strip centers, net lease properties, and many other property types. These properties are absolutely necessary to the survival and prosperity of our society, and we simply cannot function without them. Moreover, you should also know that unlike other property investors, REITs typically tend to focus on Class A properties. They really buy the prime assets in each property type because these are permanent vehicles and they need to take a long-term view to real estate investing. As a result, REITs tend to own properties that are well located, have strong tenants, good leases that are typically long, include lease escalations, low landlord responsibilities, and these type of properties are typically growing in demand but limited in supply, resulting in steady rent growth and value appreciation over the long run. The second reason why most REITs are indestructible is that they are very large and very well diversified. If you look at some of the most popular REITs today, like Public Storage, Prologis, NAREIT, Iron Mountain, and many others, most of these REITs own hundreds of properties, if not thousands of them. Occasionally, they may have an individual property go through some issues, perhaps a bankruptcy or some deferred capex, or it may be even located in a market that's temporarily suffering, but that's not really such a big deal when you own hundreds of properties all over the nation, perhaps even internationally, because then you will also have some properties that will perform even better than expected, compensating for your occasional losses. Think for yourself here, if you were a private real estate investor and you owned, let's say, 20 properties across many different states in the US, with that alone you probably think that your business is more or less indestructible, especially if you have low leverage, good management, and all these other things. Yet, despite REITs being even more diversified than that, investors tend to forget how resilient they are. Hey, before going to the third reason, I want to remind you that we recently launched a free tier to our REIT newsletter called High Yield Landlord. There we post a lot of free, high-quality research on some of our favorite REIT investment opportunities. This also includes some CEO interviews. We just recently posted one with the CEO of YCHARTS Properties as an example, which is a REIT in which we're investing. So if you want to check it out, it's completely free and will be the first link in the description of this video. Third reason why REITs are quasi indestructible is that they have very strong balance sheets. And if you look at the past, the only few times when REITs have been brought on their knees, it has been because of excessive leverage. But REITs have learned their lessons, and ever since the great financial crisis, they have greatly deleveraged their balance sheet. And as a result, today their leverage is at an all-time low at right around 35%. In comparison, most private real estate investors will operate with loan-to-values of 60 to 80%, and they still think that that's safe. So the 35% of most REITs is very conservative, and most private investors would even argue that this is way under leveraged, that they are leaving money on the table by not taking more leverage. But it is one more reason why REITs are so resilient to all types of recessions, because when you're very well diversified and you have low leverage, it's very hard to mess up things if you own good real estate and you're also well managed. And beyond the low leverage, REITs also are very smart in how they structure their balance sheet. So typically most debt will have a fixed interest rate, the debt maturities will be quite long, and they will also be well staggered to avoid having too much debt maturing in a single year. They will stagger that well across many years so that they don't face a liquidity crisis even if banks suddenly stop working, just like happened during the great financial crisis. REIT payout ratios are also today historically low at around 75%, which means that most REITs are retaining about 20 to 30% of their cash flow in-house to be able to address issues and pay off debt if needed. Finally, most REITs also have major credit facilities with significant untapped capacity to also be able to address debt maturities as they present themselves. The fourth reason why REIT bankruptcies have been so incredibly rare is that they have access to the public equity markets. Being publicly listed is yet another element that increases your odds of surviving over time, because it means that even if you go through a crisis and you have really no other options anymore, you can still sell shares in the open market to raise equity and pay off debt. This is of course dilutive, especially if your stock is heavily discounted, but diluting your shareholders by 10, 20 or even 30% is a better outcome if that allows you to survive than going bankrupt and seeing your share price go down to zero. During the great financial crisis, a lot of REITs resorted to issuing shares to pay off debt because banks suddenly stopped working. It was near impossible to refinance debt maturities. So this is a solution of last resort that can help you survive times of crisis. In comparison, most private real estate investors don't have this option. They don't have this last joker card in case of real trouble, and this explains why so many of them went bankrupt during the great financial crisis. And then the fifth reason that mitigates risks is that REITs have superior management. They have the resources to hire quite literally the best talent that exists in real estate. They typically own hundreds of millions or even billions or tens of billions worth of properties, and this gives them the financial means to offer very competitive pay packages to the best real estate talent, and obviously having those people work for you will help you mitigate risk because these people know best how to diversify a portfolio, how to structure debt, how to limit liability, and so on. REITs are so large today that in many cases they even have enough resources to hire their own legal department, lawyers that work full-time for the REIT, and having these things as part of the REIT helps you mitigate risks. Now let's look at an example. Let's consider the case of Realty Income, which is a REIT that I have quite often criticized on this channel because I've thought that some of its close peers like Agri Realty or Essential Properties Realty Trust were in a position to deliver better returns with lower risk, and so far I've been correct, but this doesn't change the fact that Realty Income is quite literally indestructible. Today it owns over 15,000 properties across nearly every state and many European countries. Those properties are mostly service-oriented net lease properties such as convenience stores, dollar stores, pharmacies, car washes, and so on. And these properties are very resilient because this is non-discretionary retail. It's not something you can easily get on e-commerce. The convenience factor is very important, and so these properties tend to keep doing well even if you're in a recession. And what protects Realty Income even further is that it has long leases with about 10 years left on them, annual rent hikes, and the tenant is responsible for all property expenses, including even the maintenance of the properties. Beyond that, the REIT has an A- investment grade rating, its loan to value is 36%, its debt maturities are long and when staggered, most of its debt has a fixed interest rate, and has significant untapped capacity on its credit facility. It's also retaining about 30% of its cash flow, so from a balance sheet perspective, this REIT is extremely conservative. And this is well reflected in its past results. The REIT has managed to grow its dividend for nearly 30 years in a row, and this includes the dot-com crash, the great financial crisis, the pandemic. And when you think of the pandemic, that was really the worst possible crisis for a REIT like Realty Income that owns mostly properties that are consumer-facing, because for a while the tenants of Realty Income couldn't even properly operate their businesses when people were just locked inside their homes, and yet even during the worst possible crisis, the REIT was still able to keep growing its dividend payment. So is Realty Income indestructible? And I think so. Bearing a nuclear war, I just don't see what could bring the REIT down, what could put it into bankruptcy, because again, as I just mentioned, even the worst possible crisis, which was a pandemic for the REIT, didn't even phase it. But Realty Income is not an exception. The same is true for most other REITs. And there are of course some exceptions. Some REITs have been too greedy and have taken too much leverage. Some other REITs own riskier, more cyclical property types and may have times struggled, especially during the down cycle. So I don't mean to say that every single REIT is indestructible, of course not. But my point is that most REITs are indestructible or quasi-indestructible, again, bearing a nuclear war or something like that. But it's very hard to mess it up because, again, if you're a real estate investor that owns high quality real estate, you're very well diversified across regions and tenants, property type, and then you have low leverage, you have some of the best talent working for you to manage this portfolio, it's just very hard to mess it up. It's quasi impossible to mess it up. And this is one of the reasons why I feel so comfortable investing so heavily in REITs. You know, I've in previous videos explained that I invest about 50% of my net worth in REITs, and many of you have told me that this is way too much, and perhaps it is for some people, but I see it a bit differently because in my opinion, REITs are really the safest type of investments that you can make in some ways because you have good inflation protection. Again, as I mentioned, the nature of the business is extremely resilient, and you can still very well diversify within the REIT segment because so vast and versatile. You can, if you invest in a farmland REIT in the US and then you invest in a cell tower REIT in Europe as an example, those are not closely correlated together. Their fundamentals are very different. You can still very well diversify it because there are over 20 different property sectors. There are REITs in over 20 different countries as well. And so I feel much more comfortable being REIT heavy than investing a lot of different type of businesses which may not have as much staying power. It's just a reality, in my opinion, that most businesses are just riskier than real estate investments, especially when they're well diversified because, you know, businesses come and go. You have a new competitor that suddenly enters your sector and there goes your business, or your patent run out, or anything else. So real estate is very well molded. It's very resilient, in my opinion. And for this reason, I expect to remain very heavily invested in REITs. If you want to access my full real money REIT portfolio, you can do so by joining High Yield Landlord, which is my REIT newsletter, for a 2-week free trial. It will be the second link in the description of this video. As soon as you join, you'll gain full access to my portfolio, all my transactions in real time, and all our research as well. Again, completely free for 2 weeks. You won't be charged anything. If it's not for you, you can cancel. You won't be charged anything. Otherwise, once more, if you could please click the like button, that will help me a lot to keep on growing. Subscribe to the channel to not miss the coverage of the EPRA REIT conference that I just recently attended. Again, thank you very much for your interest. See you at my next one. Bye-bye.